Most people spend their 20s working hard but still struggling with money. What if a few smart moves now could set you up for life? From getting out of debt to growing your savings, these milestones can make a huge difference. Some steps seem small but can turn into big results over time. Miss them, and catching up later is much harder. Stick around and you will find out the moves most people ignore that can make your 30s financially amazing. Number 1. Get out of high-interest debt. One of the first money milestones in your 20s is to get out of high-interest debt. This is usually credit cards or payday loans, and they can grow faster than you expect. In some cases, credit card interest rates can be around 18 to 20%. That means every month you delay, your debt keeps getting bigger just from the interest. It is like throwing money into a black hole where nothing comes back. Paying off these debts early is not just about saving money. It also reduces stress and gives you more freedom to save and invest. Think about it like this. If you owe $10,000 on a credit card at 18%, making only the minimum payments could take over 20 years to pay it off, and you would end up paying almost the same amount in interest as the original debt. That is money that could have been growing in your savings or investments. There are a few ways to tackle this. One is to focus on the debt with the highest interest rate first while making minimum payments on the rest. This is often called the avalanche method. You hit the biggest financial drain first so you start saving more money sooner. Another method is the snowball method, where you start with the smallest debt first. Paying it off gives you motivation and momentum, which makes it easier to tackle larger debts after. Debt consolidation is another strategy. This means combining all your debts into one loan, usually with a lower interest rate. It makes things simpler and can save you money over time. You can also try negotiating with creditors. Sometimes they will lower your interest rate or create a more manageable payment plan if you ask. Getting rid of high-interest debt is the foundation for financial freedom in your 20s. Once you are free from these chains, you can start saving, investing, and planning for bigger financial goals without the constant weight of debt dragging you down. Number 2. Build an emergency fund. Once you've freed yourself from high-interest debt, the next step is to create a safety net. This is where an emergency fund comes in. Think of it as your financial airbag. Life loves throwing curveballs. Your car could break down, your phone could die at the worst time, or you could suddenly face unexpected medical bills. Having some money set aside keeps you from falling back into debt when these things happen. Aim to save around 3 to 6 months of living expenses in a separate, easy-to-access account. This doesn't have to happen overnight. Even starting with $500 or $1,000 gives you some breathing room. That small buffer can turn a panic-inducing situation into something manageable. The key is consistency. Treat your emergency fund like a monthly subscription to your own peace of mind. Set aside a little each paycheck and watch it grow. You don't need to live like a monk to do this. You can still enjoy life, but you also have a safety net to catch you if life trips you up. Having an emergency fund changes the game. You no longer have to scramble for money or rely on credit cards when unexpected costs pop up. It gives you confidence and stability. You can handle surprises without stress and stay on track toward bigger goals like investing or buying a home. By building this fund, you're not just saving money. You're buying yourself freedom, flexibility, and peace of mind. It's one of the smartest moves you can make in your 20s to make sure financial hiccups don't turn into financial disasters. Number 3. Start saving for retirement. Once your emergency fund is set up, it's time to think about the future. Retirement might feel like a lifetime away, but starting now can make a huge difference. The magic behind this is something called compound interest. That means your money earns money, and then that money earns even more money. Over decades, even small contributions can grow into hundreds of thousands of dollars without you doing much at all. If your job offers a 401k, especially with a company match, make sure you contribute enough to get the full match. This is basically free money. It's like your employer is giving you a bonus just for planning ahead. If a 401k isn't available, a Roth IRA is another great option. You put in after-tax money, and when you retire, you can withdraw the earnings tax-free. Starting early in your 20s gives your investments decades to grow, which is something someone who waits until their 30s or 40s can't easily catch up to. Even if you can only set aside a small amount at first, it matters. Contributing $100 or $200 a month may feel tiny now, but thanks to time, it can snowball into something huge. Plus, starting early means you can afford to take slightly bigger risks in the market because you have time to ride out the ups and downs. The best part about saving for retirement in your 20s is that it becomes a habit. Your future self will thank you for being disciplined now, and you might even be able to retire earlier or live more comfortably than most people. Basically, think of it as paying your future self a nice little bonus for being smart today. Number 4. Master budgeting and cash flow management. Once you've started saving for retirement, it's time to get a clear picture of your money right now. That's where budgeting comes in. A budget isn't about restricting yourself or turning life into a math class. It's about knowing where your money is going so you can make it work for you instead of letting it slip through your fingers. A simple method that works really well is the 50-30-20 rule. Allocate 50% of your income to needs like rent, groceries, and bills. Then set aside 30% for wants, like eating out, Netflix, or that occasional treat. Finally, put 20% towards savings or investing. This approach keeps your finances balanced without feeling like a punishment. Learning to live below your means is key here. If your income goes up, don't automatically spend more. That's called lifestyle inflation, and it sneaks up faster than you realize. By keeping your spending in check, you free up money to put toward bigger goals. Maybe a down payment on a house, starting a business, or building that emergency fund even faster. Budgeting also gives you discipline. It trains you to make conscious choices with your money instead of just reacting impulsively. And here's a little bonus. Tracking your cash flow makes it way easier to spot wasteful spending. You'll be surprised how much money you're wasting on small things that add up over time. Number 5. Build good credit. Once you've got your budget under control, the next step is building good credit. Think of your credit score like a financial reputation. The higher it is, the more doors open for you. We're talking lower interest rates on mortgages, better car loans, and landlords approving your rental applications without hesitation. Basically, a good credit score makes life cheaper and easier. Building credit is not complicated, but it does require responsibility. If you have a credit card, use it wisely. Pay off the full balance every month so you don't get slammed by interest. Keep your spending below the limit, ideally using less than 30% of your available credit. And never miss a payment. One missed payment can hurt your score more than you might think. The payoff for good credit is huge. Even a small difference in interest rates can save you tens of thousands over the life of a mortgage or car loan. For example, a 0.5% difference on a $400,000 mortgage could save you over $40,000 in interest alone. That's basically like getting a discount just for being responsible with your money. The earlier you start building good credit, the better. Starting in your 20s gives you years to establish a strong history. Once you have a solid score, you'll be able to take advantage of financial opportunities that can help you grow your wealth instead of paying more just because of bad credit. Number 6. Start investing outside retirement accounts. Now that your credit is solid, it's time to make your money work even harder. While retirement accounts are fantastic, don't stop there. Investing in a taxable brokerage account gives you flexibility and access to your money before retirement. Index funds and ETFs, like the S&P 500, let you own a small piece of hundreds of companies at once, which spreads out risk and helps your money grow over time. The key is starting early and staying consistent, even if you can only invest a small amount each month. Time in the market matters far more than trying to time the market. Starting in your 20s gives your investments decades to compound, and that small effort now can turn into serious wealth later. Having clear financial goals also keeps you motivated. Maybe it's saving for a down payment on your first home, starting a business, a dream vacation, or engagement and wedding expenses. Work backward from these goals to figure out how much to save each month. This approach teaches you delayed gratification, which is one of the most powerful habits for building wealth. Investing outside retirement accounts is not just about money, it's about freedom. It gives you options and the ability to reach life goals faster, without relying solely on luck or a big paycheck. The earlier you start, the smoother the ride will be. The truth is, building wealth in your 20s isn't about luck or having everything figured out. It's about taking smart, steady steps that create a strong financial foundation. Paying off high-interest debt gives you control. An emergency fund gives you protection. Saving for retirement early gives your money time to grow. Budgeting, building good credit, and investing smartly open doors to bigger opportunities. Every step you take today shapes the life you'll live tomorrow. Even small amounts can grow into something powerful when you stay consistent. You don't need a big salary to get ahead. You just need to start early and keep going. Your 20s are your runway. The habits you build now can carry you for decades. So take action, stay focused, and let time do its work. If you found this video helpful, make sure to subscribe to the channel. Turn on notifications so you don't miss future tips that can help you grow your money and build real financial freedom. Your future self will be proud you started today. This is Minecraft, where ideas become action, and action becomes your future.